We haven't spoken since this whole debacle in stocks started, and now the economy and the numbers that are, to some, verifying and saying that this is going to be the worst crisis that we've had in history. But others will say, well, we're getting the numbers and stocks are breezing through them, so it's all priced in. Where do you fall on this argument?
Well, I look at the equity market meltdown that we've had in the last 2 months, more precipitous, steeper than 2008. And for those of us that lived through, we're trading through the great financial crisis, watch the credit market seize up, watch the ABX crack. I think what we've seen in the last few weeks, in the last, let's say, almost 2 months, has been nothing short of stunning. We've seen an equity market meltdown across multiple sectors. Growth stocks that have been the momentum trade for nearly a decade, fueled by quantitative easing, accommodative monetary policy, have completely melted down. You've seen bonds, high yield, through to investment grade and even short-term treasury markets seized up about 2 weeks ago. So this has been a global macro case study that I think they're going to be talking about in business schools for the next 2 to 3 decades, quite candidly. You've lived through history. Congratulations. You've survived. Now from here, what do we see? We don't see a V-shape. Go ahead. I'm sorry.
No, I'm just saying the verdict is still out on how to qualify survival in this situation. The stock market seems to be assessing, Mike, that maybe we can drive past this forest fire with some hazmat suits on and some protective gear and policy instead of driving into it. Do you think stocks are, should we believe what's happened the last week, rallying through these terrible data points?
Well, I think if you take a look at some of the larger institutional investors, and even outside of private or public markets, if you look at private markets, private equity, private credit, some of these alternative investment managers have over $2 trillion of dry powder. In other words, they've gone out, they've raised $2 trillion worth of capital commitments in closed-end funds, and they've been waiting, praying for a dislocation in the market. They didn't know it was going to be this, but they were hoping that there was going to be some kind of a black swan moment, which they could draw down on their capital reserves in these private equity, private debt, private real estate funds, and then feast on the opportunity and distress in the market. Well, this is unfortunately what we're looking at now, is the distress in the market. And now things that were selling at $100 are now on sale for $25, even $18. And when you look at oil, it's sub $20. This is an environment right now where value investors are sharpening their pencils. They're looking at high quality, value-based dividend stocks, as well as private equity managers, private fund managers are analyzing things like energy, real estate, as well as other types of natural resource plays as to where they can get the best money and deepest value.
You spent a lot of time here in your notes this morning talking about real estate and REITs. Right now, is the market going to be choosy and which ones make sense? Because if the worst case stories we hear are true, Michael, about businesses shutting down or commercial enterprises unable to restart, that doesn't sound great for those that get paid on rents for tenants. I mean, is this a group that you want to be in as a whole, or do you have to get specific? What do you like? What do you don't like here?
I think it's a great question, Oliver. You need to be surgical. If you're looking for a deep value, think hotel REITs. RevPAR is going to be off. These are structural impediments, and so the sectors in REITs, if you look at what's really going to be hit, senior housing, mall, any types of entertainment. So think some of these casino REITs and other things like that, as well as office sectors. Conversely, what's really held up in our client portfolios, institutional and the funds that we manage, is across cell towers, data centers, so think technology that's insulated from COVID, as well as single family rents. So you can balance your portfolio, but we've already started to see some activity bids from private equity real estate managers, particularly in some of the sectors around senior housing, malls, as well as entertainment and office. And if you look across some of the other areas that we pointed out that have held up, that have been quite resilient, cell towers and data centers really haven't moved off the bid too much, and you're seeing industrial logistics and multifamily apartments really have held up well. And those are going to be the ones that snap back the fastest, and I think they're going to be more resilient. The other sectors that are negatively impacted So think hotels, they're going to be more of a U-shaped recovery.
Okay. Right now, some would say, is there going to be a recovery at all for some of these, Michael? We've gotten a big collapse in crude prices reflecting demand. I know you and I have discussed what the future might look like if there is an inflationary impulse, and commodities and materials have been part of your case for that. Crude's gotten demolished. How does crude come back if the worst estimates are right and businesses are stopped out for a long period of time and some don't recover? What does that mean for demand of goods and commodities?
So great question. What I look at is we've been through, in the last 2 years, PMIs in September of 2018 that were in the top 5% of all PMIs recorded in the last 100 years. Then we saw a deceleration slowly. Now we've seen a complete collapse in PMIs. But we look at this all related to this health scare around coronavirus. So one needs to take a look at where it started in China, the negative impact to their economy. Now the fact that you're looking at months later, 6, 8, 9 months later, they're starting to open parks. People are starting to go back to work. You're starting to see their economy slightly rebound. That's a mirror, or that's a mirror image, or that's an indication, a blueprint as to where our economy is going to be in 6 to 9 months. If you look at the recovery, China's utilized technology, facial recognition, quarantine. We were lagging them in terms of the cases that were diagnosed, and we're still going through the accelerated curve scenario. So it's going to be another 6 to 9 months until we see some real significant bounce back or snap back in the economy. That's why times like this, you look at your point about energy, high quality dividend stocks, particularly some of the mid to larger cap names that have dividend payout ratios that are in that 20 to 30, 40% range. Anything higher than that, you're going to see the energy stocks are going to cut dividends. It's already started to happen. That's going to happen with some of the higher 50+% dividend payout ratios. I'd stay away from those types of energy stocks. We have a tendency towards quality and value in energy. When you look at real estate, again, we have a tendency towards quality in the publicly traded REITs. Any other types of infrastructure or natural resources, you want to tend towards larger is better, quality is better. Dividend payout ratios that are less than 50%, preferably 20 to 30%, and those are the names that are going to yield higher than bonds, have a better risk premia in terms of your risk return scenario, and incorporate that in a diversified asset allocation portfolio.
Mike, we're about to take the opening bell here. I just want to bring up one chart you brought us here before we say goodbye, though, because it's from the Goldman team that's basically looking at their dividend expectations for growth and their earnings expectations for growth. And it's ugly. It's a scatter plot that's putting these two together. And right now, they're basically expecting one of the worst combinations ever. I mean, the final point here to kind of wrap it up, if you had to assign a probability to that, I mean, are we going to get down to Great Depression level on this chart where Goldman's predicting? If, again, we're walking into this with a ton of fiscal outlay and monetary outlay before the data's really even gotten bad. I mean, we've gotten one data point. I mean, I know it was like the worst in history, but so far it's only been like 5 days of actual information here.
Yeah, that's correct. So when you look at that type of assumption, that's a worst case scenario. I go back to the $2 trillion of dry powder capital that are in private market funds, and the ability to step in and buy distressed companies, particularly in places like the energy sector. They're going to see a lot of these companies where they cut their dividend. You're going to start to see some capital impairment, but private markets and private equity is going to step in, and you're going to see a lot of the acquisition activity. And admittedly, we've seen a lot of bids. We manage both public and private market securities. We've seen a lot of bids in private markets, leading to that indication that these funds are drawing down on their dry powder, and they're going to start acquiring publicly traded companies that are selling for pennies on the dollar.